Greetings, Dr. Jeffrey Scott here. This is my part two of my weekend market update. Um, Part one, which I did on Friday night, the 23rd, dives deep into the market and why I think this market still can go higher. Obviously, there's so much this week that we'll talk about from the data, and we've got two, tariffs on August 1st are supposed to come back, but by the time I've already done this, I've heard that there's a 90-day extension coming for China and that maybe a 15% deal is in play with the EU. And if that's the case, maybe the market will rally on that. But more to discuss about what the week's going to have. As I looked at my buys this week, it's all about data center expansion. And it kind of feels like we've got the new dot-com boom. So we're going to look at some of that today. And so what I'm going to do is make a few comments about the market, where I think we might be going. Then I'm going to review my buy watch list and talk about how for Market MRI Pro, it's either active now or will be pushed. Not sure which update's going to do that, but I know that's one that Praveen has got done. And then I'll talk about how I'm going to play my pick of the week. Again, my name is Jeffrey Scott, marketmripro@gmail.com, Google Group Top Down Trader. And for the more detailed market review, please see the video from the 23rd. Disclaimer, this and everything I do is for educational purposes only. Nothing should be taken as investment advice, but rather as education. The intent of the video is to demonstrate how I use my tools for top-down analysis, how I apply them. Trading involves risk. You are solely responsible for any decisions you make. I'm a owner intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky. You should consult with your financial advisor before making trades. And I have tools for multiple platforms, but am an independent trader. If you're looking for the Wealth Charts video, come on back to Stocks and Docs on Monday morning. It'll be posted before the market opens. My Google group is called Top Down Trader. It is free. You get all kinds of benefits. You get discounts on my software. You get a nightly newsletter at no charge. You get my ranting and ravings, and you don't have to read them. Just hit the delete key. And you'll also get invited to some private educational seminars I do for free online, pretty much on a monthly basis. If you have my tools at any of the platforms, it's a good thing to join because I talk about how I use the different platforms for trading. Speaking of how I use the platforms for trading, had a pretty nice bump after announcing this last week. Remember, there's only 12 people that I'm going to have in the room. The rest will be on internet, and the room's about halfway full. So if you sent me notices last week that you want to come, you're going to get your link tonight. So you'll be getting those shortly. Location, I'm down to the last two or three. They're all in Palm Beach Gardens off of PGA. So, book your flights. We won't get done on the 28th until 5. If you want to fly out earlier, that's fine. It'll be recorded. If you're coming for John Persons, that's even better. You'll get 4 days of education. It's $12.50 on live or internet. If you show up live, I'm going to feed you and water you all day long. Breakfast and lunch, dinner on Sunday night, and weather permitting. And I'll make the call probably days before the meeting, whether to take you out to a fancy steak dinner or go for a cruise on Stocks and Docks, the yacht. I'm interested in the boat, so we're going to plan the boat. Again, lots of education. We'll spend plenty of time, one-on-one time for software instruction, back to back with the John Person seminar, which is the 25th and 26th, which is a separate fee. And for more information, contact me, Jeffrey Scott at marketmripro@gmail.com. I'm not going to go through this except to say this is a wow week. This is even before the tariff stuff comes in. And Tariff Friday is the day we would be concerned about. But we've got PCE, we got employment, monthly employment, we got GDP, we got ADP, and oh yeah, we got a Fed conference, and look at how many earnings releases. So as I like to say, it is a judgment call to hold stocks over earnings dates, and it is just bad judgment to not know when your stock's earnings date is scheduled. So as I did my buy watch list this week, and if I think about OKLO, LEU, some of the things that we've talked about the last couple of weeks, the nuclears. It came to me that these are all companies involved in benefiting from data center expansion. So whether it's the utilities, WEC, energy providers, any of the small nuclear reactor companies, cloud and hyperscaler companies, cooling and power infrastructure, um, semiconductors and hardware, construction and real estate, and then telecom and fiber, all of these are needed to support that rapid expansion. Maybe these are all going higher if this boom continues. Some of the companies, you've heard a few of these, obviously. Microsoft, Amazon, Google, Meta, NVIDIA, part of the FANG complex. So they've all got a lot of wind at their backs, even though not all their chart patterns look like that. Oracle popped into the list, NVIDIA, and then some of the utilities, Entergy, Southern Company, and there's your WEC. So these are companies leading the charge, but there's a lot of smaller companies that are there as well. And it might be easier to get massive moves in a smaller company like Bloom Energy than in a Google, Amazon, or Microsoft. So let's go take a look at the charts, and this is a deeper dive into stocks. And let's go and let me just make a few comments on the market without going into great detail. My timing model says be long. Whether I look at the dailies, should have loaded this first, or the weeklies, we are in long. All right, so that's the first thing. The second thing is if you want to be concerned, you could see the RSI divergence on the Russell. Okay, you could see that on the NASDAQ, even though we're setting a new high, the stocks above the 20, the 50, and the 200 actually came down. In fact, if you look at the spider, even going higher, stocks above 13-week new highs versus new lows, yeah, it's kind of flat. Maybe it can't get much higher, but there's divergences here. Some of the things that I spend a lot of time looking at, the 13-week new high, new low, think the T2121 from Warden, 0.92. Spiders are pretty ripe. They're extended, but they can get higher. But the others came down. We're down to 75% on the NASDAQ, 77 on the Russell, and in the middle, the S&P 1500 at 88. So that's not giving me a signal right now. When I looked at my overall market breadth, and we're loading 20, 30 years worth of data, so it takes a couple seconds to do this, even on fast internet, but you could see all-time highs were sent this on closing highs on the NYSE on Friday and the NASDAQ composite. So the spiders, the Qs, the NYSE, the NASDAQ composite, and they're all firing a lot of bangos, which is an exuberance to the upside. And when I looked at the index ETFs, and I don't want to go too detailed right here, I basically concluded on all of these that they're all in a nice uptrend. Spiders, Qs, diamonds lagging a little bit, have not hit their all-time highs. And then the Russell hasn't hit their all-time highs. But none of them look like they were breaking down. So even though we had some mixed days this past week, I thought the market still looked great. Volatility is low, and eventually low is bad because, as my peer, friend, colleague, great speaker, now deceased George Lee used to say, when the VIX is high, it's time to buy. When the VIX is low, look out below. VIX is pretty low. And the dollar is struggling underneath at recent lows. And I think this might be an interesting line here to see if it can't get above. And I think the markets certainly like a weak dollar. And then the other thing, just to comment on very briefly on the commodity side, um, the most important thing to me was we might be getting a turn down on the 10-year and the 30-year, and the 30-year came down from that 5% level. So a lot of things here to like. Again, we had positive tariff news already, and that may be the biggest influence on the market. So what I want to talk about is my buy watch list and just go through some of the companies that I thought were interesting. And for the sake of making my life easy, I'm going to keep the earnings window open. And the reason for that is because the earnings window, well, I may keep has the next earnings date there. So let's take a look at what we have. ACM, industrial, don't remember what they do, might be some defense. Like the market, big V-based recovery, a little pullback here. And when I looked at what I saw on Friday, I had a big move here. It was not earnings. So you can even open up the news here, but that'll block the earnings. Well, Bill, yeah, don't know what they do. Don't really care what they do, to be honest. I could see seasonality here in red 5 years and green 10 years. Doesn't look bad. And I could see we had a big up day, up 2% on Friday. This is a CPR, which is one of my proprietary indicators. This is an EMS, which when it goes from red to black, I know I'm switching from a sell to a buy. This is a breakout, and that's a momentum coming out of a squeeze. And we're looking at relative strength and OBV turning up. This is AEM, and it's not extended with my proprietary high jump indicator. AEM was one of my favorite gold, and I think this one also has silver and maybe nickel play. Beautiful uptrend. You had a little pullback here at Doji on Thursday, and then we had a nice move up on Friday. Gold has will be paying attention, I think, to what the Fed says. AEO, American Eagle Outfitters, obviously a horrible downtrend, and it had a big move up here on Thursday, inside bar on Friday. I'm more watching this. I think what this must have been not as bad as people thought, um, because it responded very well over the last couple of days. I'll maybe back that up. Earnings were bad back in May. It bounced here. I don't know if people think we're going to see a turnaround in the sector. Now, one thing I would do want to point out that we did built into this. Somebody wrote solid value and awesome turnaround potential. You might want to read who did that. Hit Seeking Alpha, hit the link, and it actually will come up. And why did it pop? Now I remember. And I think she's beautiful, but it popped because Sydney Sweeney's their new spokesperson or new model. Well, whatever. I'm not a teen buyer. I really like AGX a lot. I liked it better on Friday. AGX is a infrastructure play. I believe it has data center business, and I kind of see we had a breakout here from kind of a wedge, and I think this one looks great. Earnings are not to September. Look at the earnings per share growth. Look at the surprises. Look at the revenue growth and surprises. And it doesn't trade at a crazy multiple. AGX, and that's the one we'll be working up. Arthur J. Gallagher is a insurance stock. And why did I pick it? Because if this market gets weak and sells off, some of these insurance stocks have been decent havens during weakness in the market. And I like to buy things on sale. And AGG is on sale sitting here down on the 200. What do I not like about it? It's below the 50. But what I see here is a big move off the 200. You had the EMS and CPR breakout and momentum and relative strength and OBV starting to turn up. ALVO, I've tried to find decent healthcare stocks. There are not a lot, and now I can't remember what I liked about this. Oh yeah, Wall Street analyst sees a 91% upside in ALVO. Sometimes I see a medical thing that shows me a drug story. You'd have to read the Zacks reasoning. But again, it had 3-day move here, about to take out the 50, coming out of a squeeze, a PSAR reversal, my two momentum dots in a row, which is really my go-to signal, and the relative strength in OBV turning up. Aon, I think they're in the benefits and insurance world. breakout above the 200. I don't like where it closed, but it's hard for me to ignore. Earnings are out, so some of the risk is gone. Nice earnings per share growth, doesn't pay much of a dividend. Yeah, it's $3 on a $400 stock. ARGX is one I talked about on Thursday night, and it didn't break above the 200 yet, but it's one that I like a lot. And their earnings, I believe, are out. I just don't have much detail on them. Here they are, my bad. Got confused there. 725, major move in earnings up 111, big surprise, revenue up. ARGX, ATKR is a, don't know what they do, but I like stocks that break out, kind of retest off the 200. I mentioned Bloom Energy. They did a deal. I don't know if it was with Oracle. Let's see. Uh, yep, they did a deal with Oracle around powering data centers, data centers, data centers. BWXT is one that I liked a lot down here breaking out. Just gave me another bit of perhaps of a setup. Again, it's my watch list. It doesn't mean I'm going to buy any of these, but these are stocks that I'm watching. Nice little breakout there. Um, and it's got my 2-dot momentum signals, which has been a recurring winner. CBIZ breaking out above the 200 here. Chemours Chemical, it's in a nice little uptrend, more of a watch. Um, Celsius and Monster Drinks both got upgrades this week. Pull back here in a rebound. CENX aluminum, big breakout here. Look at the earnings per share growth, big turnaround stock. Confluent breaking out here above the 200. Coherent. A lot of these tech stocks have involvement in the data center space. Probably not my favorite yet. Let me just try that again. But if it breaks out above that line with any volume, I might be interested. CRBG, um, a financial services. Oh, yeah, I know who these are. Corebridge. They have some of my money. And they've turned, I remember we were friends with somebody who worked there and he was just starting a fund and I gave him 1 million and he turned it into 4. That's not bad. Corebridge. CRDO, data center. This is a stock. It's had obviously a big run, pullback, and a breakout. It'd have to clear for me to get interested. It probably clear in this area here. We've got the right one. Um, it's involved in cooling. CRH is a construction, basic materials, breaking out. CSL, Carlisle, a lot of the asset managers looked interesting here and have had some recent recoveries after selling off. There's this potential for us to use our 401ks and private equity, and I think that's got a lot of people excited, good and bad. Um, Pays a 1% dividend. DoorDash, I use Uber Eats almost every day for work. And I remember watching this move here and thinking, oh man, do I really want to invest in a company that delivers meals? Well, I should have. And in fact, you can look right here and say, hey, it's doing the same thing and it just broke out. DoorDash, look at the earnings per share growth rates. Look at the revenue and growth rates. High PE, but maybe there's a reason. Deckers popped on earnings, which came out on the 24th. They had a big surprise. The revenue, not so much. I don't like where it closed, but that could stimulate clothing and apparel and shoes, thinking Nike and other stocks that might benefit. DHR, Danaher, this is one of the lab companies. A lot of them look like this. Thermo's another one that started to move, just to watch. Exelixis, this is a company that never gets respect, I think, from Wall Street. In fact, if I put a long-term chart on it, you can see up until now it never really did anything. They've been a one-drug story, but they've just launched another drug. um, in small volume diseases. But this one looks interesting, and I do seek to do business with them. So, breakout above that area might be interesting. Wow, this one, Fix, Comfort Systems. I guess data centers need cooling, and plus houses do. And I mean, have you ever seen a earnings and revenue growth list where everything is green? Let me tell you what that means. It means that they have massive quarter over quarter. They're comparing 653 to 374. Next quarter, we're going to compare 506 to 409. Okay. So you've got not only you have great growth, you have big time surprises every quarter. You look at the revenue, you got revenue growth to support the earnings. You look at the multiple at 34, it's below, it's half of the earnings growth rate. Ridiculous great move on Friday. Boy, any pullback from here, any weakness, you got to be fixing yourself. FTAI, why did I like this guy? 1% dividend. I know I liked it because I remember those days. I think they're in a leasing business. Not sure like URI or not. FTRE is a Fortune Holdings, and I don't like to see. There was something I liked about these guys, but I don't like the fact that everything I see here is a lawyer helping people who lost money. So maybe I should take that out of my list. Don't know what the story is on that. Obviously, it's a stock that died, but all of a sudden it's had multiple days in a row. It's turned to blue. Relative strength and OBV are picking it up. Cheap stock here. This is American Express Global Travel. You look at bookings, you look at some of the other travel stocks are doing well. Expedia, maybe this one's going to join the party. This is the wow. We talked about this on Thursday. GEV, what's driving it? Look at the earnings per share growth, great revenue growth, surprises. PE is high, but it's not high when you look at that. Why? Data centers, energy, data centers, and everything else. Not a lot of pharmas and biotech stocks on my list these days because, face it, pharma and biotech have a lot of problems with the White House. The White House wants to cut drug pricing. I don't blame the White House. I am in healthcare, and we have some major issues in healthcare we have to solve. But this is breaking out. Gilead is probably the company that the reason you don't hear about HIV and all the deaths of AIDS is called Gilead. Hepatitis C, Gilead. This is the greatest antiviral cure company ever. And I love the company. They got an oncology presence now. And look at this, they're breaking out and look at their last quarter's growth. And you're going to see $1.96 versus 201. So kind of flat on earnings, flat on revenue. Any beat there should be enough to propel it higher. Global online. Don't know much about this stock, more of a watch. GTX is in the auto parts, Garrett Motion, and it broke out on Thursday. Didn't like where it closed, but I loved Friday. Hood, don't need to say anything. People know I've been trading Hood for a while. I'm still in it, although I've trimmed. But boy, look what happened on Friday. I mean, it's benefited from Bitcoin. It's benefiting from the secure coins that are coming out. Volumes are going up on their trading platform. So Hood has looked good. But sometimes you got to ka-ching, ring the register. And you can see it's on the high jump. It was at 100%, which is why I trimmed. Right now, the high jump has come down quite a bit. HWM, this is a defense play. Defense has been strong. Lilly is the other one of the other pharma stocks I put. Now, the problem with Lilly is it's so dependent on this drug called Mounjaro. And it is a great drug. I say that from experience. I've lost a ton of weight because of Mounjaro. So I really love this company. I want to buy it. Look at this, 559 coming in versus 392. 1465, that's 1.4 billion in sales, I guess, versus 1130. Great growth in earnings and revenue. This is just one of the targets for Trump's administration. Las Vegas Sands, improvement in Macau. That's where much I think of their revenue comes from. Nice breakout and a pullback. Looks like this one wants to go. Newmont is another one of the gold stocks that look good, probably one of the best. Its earnings are out. They had a massive surprise on earnings and revenue. Annaly Mortgage, not a great looking chart, sideways movement, although it looks like it's going higher. 15.6% dividend. Nucor Steel, a lot of the steel stocks look good. I mean, gone from a downtrend to an uptrend, little pullback pivot here, and then we had CPR, already had the EMS fire. You had a breakout signal, and relative strength and OBV look like they're coming up. NVIDIA, not much to say. I don't know when you get off this train, but as long as they have good earnings and beat them, they're the king of data centers because of the chips. NWG, NatWest Group, is a beautiful, tight little chart here of a regional bank, pays a 5% dividend, earnings are out. Oklo, one of my favorites that I'm currently in the clean energy support of the data centers. OKTA, I can't remember what they do. Technology, I don't know if they're data center or not. Why did I like them? Oh, they're moving up off the 200. This is more of a watch, not buy. ORN, Orion Group Holdings, little pullback here. It's a little small stock. Pega has been a great stock. It died, but I think it didn't die. I think this is a data fix I need from Praveen. This company's got the problem. This is the company from the Coldplay Kiss Cam. Oi, yeah, Pega looks great. Nice little uptrend breaking out here um, off the pivot. So Pega is one that looks good. I'll have to have Praveen fix the chart. Provident Financial Systems pays almost a 5% dividend, a break above the 200, a retest, a big move up on with the CPR volume, breakout momentum, a PSAR reversal, good RS and OBV. Impinji, another technology play. I'm going to watch it and see if it can break above the 200. SC is another one I've been in all year long, a beautiful uptrend. It's a you got to have a stomach of steel or sell it and buy it back. But this thing's in a great uptrend. Look at the earnings turnaround that it has here, 800, 6,300, 309%. I think um, this one looks good. SEI, think they're involved in the infrastructure support of data centers. Big gap up on earnings with a big, look at that earnings per share and revenue growth with surprises on looks like on Friday. It must have been Thursday and then Friday. Maybe came out after hours Thursday because it kind of looks like the move occurred on Thursday. Friday it kind of had a weird looking day. Sezzle, I look at it's kind of like an Affirm. Ran it up here. Time to buy it again, perhaps. A little bit riskier than when this move occurred. But this thing is one of those buy now, pay laters. Shopify, one of my all-time favorites. It gets kind of loose, but pull back here looks like, is it ready to go again? SLDE is an insurance play. It's an IPO, one I'm just watching. SMR is one of those small nuclear power companies. SMR, big pullback when the speculative stocks got killed and back here at all-time highs. SMTC, another tech play, broke above the 200, little pullback, looks like it wants to go higher. Snow, boy, pull back to the 50 and moving, like Snow a lot. Sterling Infrastructure, this is another build out construction play of the infrastructure. Is it too far gone? maybe. Look at the great earnings per share growth, surprises. Multiple is 28. SXT, Sensient Technologies, Basic Materials. I can't remember what they did, but look at this. We call this a belt hold. This is not only is this a bullish engulfing pattern, it took out like 1, 2, 3, like 18 days worth. Got to be a news event. Let's see. It was earnings. Earnings per share. It was 25th was Friday, not 23rd. Up 22%. Revenue up 41 with a big surprise. That's a beautiful candle. SYRE is another one of the healthcare stocks. Again, I'm not buying this. It's below the 200. It's close enough. I'll wait and see if it gets above. Putting it on my watch list. That's what this is a list for. Here's another involved in the data center energy space. Talon, this is where I looked at it. To me, it's too extended. It's at 100% on the high jump. Doesn't mean it can't go higher. Toast, I love this. I love what they do. I love the fact I don't have to deal with those blue carbons, which I know dates me, but a lot less fraud and abuse on our credit cards. So I like this one a lot. I like it here. Um, it's not yet to above plus 95. This thing up at the top, that high jump I've been referring to, as long as it's below 90 and maybe 95, I'd still consider entering something. And you kind of got a cup and a handle and a breakout here. United Rentals, someone's got to rent all that equipment that they're using to build the infrastructure, to build the data centers. Super expensive stock. Um, I've had this from time to time. Doesn't pay much of a dividend. This one probably runs up with some of with the data center. Viva is a healthcare technology stock, and it's had a nice breakout, failed here, but if it gets above this line, kind of like would be interested in it. VeriSign, I think of this as an old company, and it doesn't look like an old company's growth, does it? And then same basic thing. I mean, it went sideways, base for a little while, and broke out on Friday on massive volume on earnings that showed a little bit of a positive change on earnings and revenue, though not a big surprise. Pays $3, but it's less than 1%. VRT, data center cooling. This one fell here because Amazon announced some their own cooling for their AWS data centers. And that if they took that and sold it to other people, that could hurt the business of CRDO and VRT. And then next thing you hear is that, oh, wait, they might be producing them for Amazon. And all of a sudden it's going back here. Look at the earnings per share growth. Look at the revenue growth. It's got a multiple that's high, but it's not that high. I think VRT goes higher. Here is a cheap biotech. Roll the dice. This is typical to the other one I gave you, AGEN. This one has revenue, which is different from the other. It's not profitable. They've got a drug on the market, and which is not a big deal. But they've got a new drug, a targeted therapy for cancer that looks really interesting. The data is super strong, and you wonder if an approval doesn't take this higher. It's got a $184 million market cap. The big biotechs and pharmas are starving for drugs. No one cared about their first drug, apparently. But this one looks interesting here. Do your research, don't trust me. And then Z-Lab is a Chinese biotech that we don't hear much of in this country, but they are behind stocks that, drugs at Regeneron, B1, also known as Beijing in the past, and a number of others. So these are some of the stocks that I thought were compelling. Now, why would I have so many stocks in a watch list? It's simple because I could take my watch list. Give me a second to move something over. Uh-oh, where'd it go? I think I just killed it. Well, I can run inside. Where did that go? Oh, well, I'm not going to find inside TradeStation. Inside, there he goes. This is why I don't love TradeStation. I can run a watch list or a radar screen and look for these to give me my buy sell signals. So the one I like the best, the one I want to end with and spend the next 10 minutes on and say goodbye is AGX. So let's look up AGX. So let's first go to, go back and look at it. AGX. And let's just see if there's any recent stories. The stock that could fuel America, AI. Well, that's a pretty strong comment, isn't it? You could go into here. Surging U.S. energy demand, 1.86 backlog, strong margin expansion, AI and EV, robust balance sheet, $238 price target. Well, that's about where we're at today. Key risks, portfolio allocation, that goes back not long ago. So that right away you got the concern, is it already met its price objective? But I was interested in AGX, and it's a lot of it has to do with this. I'll also typically pull up market surge. Why? This is a weekly chart because in market search, I can validate the earnings. $8.34, 25% growth. 25 is big growth, 26 it slows down on big dollars. So that's something keep in the back of my mind. These are some of the stocks in similar groups. We looked at Sterling Construction. They're buying back their stock. That's a good thing. So if I decide tomorrow that I want to play AGX, and by technicals, I want to play AGX, I'll be watching it. How can I play it? I mean, I'm not poor, but a $235 stock, 1,000 shares is 235,000. 5,000 shares is 1.2 or so, or one, a little bit less than 1.2 million. So probably not buying a ton. So I decided to go into my Option Pro, not mine. This is I think it's Tom Joseph software, and then VectorVest licenses it and sells it for probably more money. But let's take a look. AGX spread type. I picked an expiration date of 54 days, starting price of 230, minimum rate. I just picked the $10 spread. That might be too little. And then I looked at all the bullish trades I would consider. So the first one I looked at, let's take a look at it, was this one here. And this is if I buy the stock. Now, to buy 100 shares, it's going to cost me $23,591. Well, you know, that's a lot of money. Do I really want to tie up 23,000, call it $24,000 in one trade for 100 shares? As the stock price goes up to the right, your profits go up. As the stock price drops to the left, you lose money. The nice thing about buying the stock is it doesn't have to move any to cover the cost of premium. There's no premium in the stock price. So you get every dollar up, but you lose every dollar down. I don't like the cost and I don't like this risk here. Now, we know we're going to put a stop in here and we're not going to lose that much money. But the reality is, if you have a gap against you, the stop didn't help you. So this is what I'd like to see. Kind of looks like this. Why do I buy a lot of calls? Because the call has the same basic unlimited gain like that. It's got a fixed risk. So even if the stock gaps down, the most you can lose is what you paid for the call. And now spending what I say 24,000, 26,000 to own 100 shares, I think we said 24,000. I can pay for 100 shares. I only got to pay $2,900. So 1/10, about 1/10 to control the same number of shares. Okay. That's, interesting. So I can control a lot, but I got this problem right here. And that problem says the stock's got to move. It's got to move a lot. I don't break even in this trade until I get to 259.60. So that $29, it's got to take care of, it's a 230 strike price. So I break even at 259.60, which is your break even point. So I got to move like $24 to break even. I don't like that. I could live with this, but I want to do better. Okay, what else could I do? How about shorting a put? Because the beauty of shorting a put is I'm profitable the first day if I hold it to expiration. Why? Because here's where the stock price is, and I have maximum gain today. And as long as the price goes up, I have max gain. The other good news is I have $22 in my pocket. So $2,200 would have to drop the value before I lose money because I got paid $2,200 up front. So the break even on this trade is going to be $208. Wow. So I'd have to drop almost 10% for me not to make money. So there's a high likelihood I'm going to make money on this trade, but I don't like it. I still could have a big loss. No, I'm not going to do that one. I know why people do it. Okay. All right. What about this one? Let's just do a covered call. That's not a bad trade. Um, the problem is a couple of things. So instead of paying 23.59, 22, to buy 23,591 to buy 100 shares, I can buy 100 shares here for 20,772 because I'm selling a call for $29. So that tells me a couple of things. I am going to make the strike price plus the premium. 259 is the most I can make on this trade, minus here, most I can make on this is that $29.60, and not even because it's a 230 call. So the most I can really make on this is $24.31. That's it. And I got to buy the stock, and and then I sell, and then I get capital back from the put, but I'm still going to have a lot of my capital tied up. The good news with this play, it has to lose 20, almost $30 for me to lose money, just like being short a put. But again, like being short the put, I'm capped at my gain. So, and I don't have control on the downside. I don't like this one. Next. Of course, as we said, you have stops at play. All right. What do we got here? Yes, I built this before we started. How about a bull call spread? All of a sudden, I can control 100 shares now for $4,800. I like that. It's much cheaper. Actually, not $4,800, $4 and $480 controls 100 shares versus 23,600 to control 100 shares of stock. The bad news is it's only until the expiration date, but I still got until the middle of September. I like that. Um, but here's the problem. Even though I have limited my downside, the most I can make is the short strike price, which is 240, minus the long strike price, which is 230, is $10. But I'm paying $4.80 for that. So the most I can make is 520. Now, notice it doesn't have to move to the right to be profitable. I don't lose money until it falls a couple bucks. But again, I want unlimited upside and limited downside. That doesn't do it for me. All right, what else do I got here? How about a bull put spread? So I'm going to sell you a 220 put, excuse me, a 230 put for 22 bucks. And I'm going to buy myself an $18 put for, excuse me, a 220 put for $18. So you're going to pay me $4.20. So as long as we don't lose $4.20 on the stock price from the 230, okay, as long as I stay above 230, I get to keep the money. As it drops below 230, the first $4, I'm in good shape because I already got paid that up front. So I just give you back the money you gave me. But then I have the what happens if it keeps falling. Now, the good news on this trade is the most I get 420 for making the trade. The most I could lose on 100 shares is $580. But I'm capping my gains. If this stock goes crazy up, I'm going to be unhappy as can be. Don't like that one. And then how about married put? And I've added this to my discussion because I like these. And I'm starting to think more about taking more of these. So let's put this in my 4 trades I like. Why do I like it? Unlimited upside, control downside. I still have to move, but instead of having to move $26 or $28, I'm only going to have to move $22. So I move less to cover my put. But notice, notice um, that my downside is capped. That if I have a $230 put, the most I could lose on the stock is I'm buying it for 235. I'm protected at 230 is $5, but I could also lose that $22 I paid for that put. So $27 or so is what I could risk. So it's 28.11 when you add up the cents is my maximum downside, controlling 100 shares, and I'd have to compare this. I'll show you in a second, infinite upside, and I have to compare that trade. Let's pull that married put back up here. With this trade, which is a long call. Don't they look similar? All right, so what would I look at? This one is 28 to 31. So let's say I pay 30 bucks or 29.60 to buy the call. Here I'm buying the same protection for $22.20. Okay, meaning I'm paying 22.20 to get unlimited upside and limited downside. Here I'm risking 29.60 on the call. Here I'm risking 28.11. So similar, but hell, it's, excuse me, better in my opinion. Break even's a little lower. The married put looks just like a call, but maybe better. What's the problem with the married put? Well, it's the same problem with the call. They expire over time. Um, but in the married put, I got to buy the stock. So I have to still put out the 23,600 bucks. So the married put does not look bad here. In fact, I think the married put looks interesting. So let's shut this down. Let's go to a couple other trades I like. Next one I like is the butterfly. Now, I don't like the traditional butterfly because that's the traditional butterfly. I'm buying one in the money. I'm selling two, in this case, at the money, and buying one out of the money. It costs me nothing. To control 100 shares, I'm going to spend 50 bucks. I can make 950 bucks. Okay, that's awesome. What's the likelihood that I finish here? Zero. Don't even think about it. It's not going to happen. You'd be lucky to finish between 220 and 240. You're not giving yourself. Why are these popular? Why do people buy lottery tickets? They're cheap. Their payouts are good. Okay. 950 payout versus a $50 investment as max. You have an area that you're profitable, small area that you make the big bucks. You pay nothing, but odds are almost 100% you're not going to finish in the money. I don't like this trade. However, we can play a game and we could say, buy one in the money, and we could change that if I want to make it cheaper. Sell two out of the money, and I took $30 between the two, and then buy one at 260, $10. So I've got 30, a $30 call spread wide, and a $10 put spread wide. So if the price goes to 280 in this trade, I will make 30 minus 10 is 20 minus the $10.50. So I am betting 10 to make 10 or selling it for 20. So my maximum risk is 1050. My maximum profits is 1950. So it's a 2-to-1, but the maximum profits are here. But I'm willing to accept a $10 profit if I'm right on direction. It just goes beyond my expectation. The beauty of this trade versus the one I just showed you is we got the same point here, but then I got this broken wing here, broken wing butterfly, that no matter how far it goes to the right, I'm still going to make money on the trade. And I've capped it. And at $10.10 compared to the low 20s to get into a call, it's a much cheaper trade. The downside is I'm capping my gain. And one thing that I've learned is you don't do this trade at earnings times if you think you're going to get a big move. And you don't do this before an FDA approval if you think you'll get a big move because you'll make money, but you won't make the max. So one of my favorite trades is a broken wing butterfly. So the Mary put and the broken wing butterfly are two of them. All right. The next one I'm going to show you is a call ratio back spread. Now this is a complex trade and you can structure them many different ways. You'll note it has the unlimited upside. That's good. It has the fixed downside. That's good. It costs less than a call does. I think the call was about $26. We can look right here. A call was closer to $30. My bad. So what we're basically doing to construct this, one way to construct it would be to sell a 230 and then buy two 240s. So you're financing a big part of the cost of the too long by the short. Now, until you get to 245-ish, let's see, break even is 270. So you've got to cover your 20 bucks plus 10 bucks above the 240 to make up the loss of $10 between the two. You got to get to 270. So you've got to have a move of a big move, a 34 and 9 cents move. Your risk is capped at $3,000. Why is it more than what you're buying it for? Because there's a period of time, like upside down that butterfly, where the one between 1 and 2 could be minus $10 if it comes in at 240 on the nose. So you have to make up the $10 plus the $20 you spent is 30 times 100 is 3,000. So if you have something that you think is going to go a long way, you could look at a call ratio back spread. Now I've been watching this thing called the Zebra. We're almost done. We've gone way too long. I apologize. And the Zebra, you're actually going to buy two here at the lower strike price, and you're going to sell one at the higher strike price. And this changes the trade considerably. In the zebra, your debit is $34.40 because you're buying two of the expensive ones. But the difference is you only have to cover the $24 from the 230 or 254. So you break even at $18, so $10 less to break even. You still get the big upside and you don't have that dimple of the bigger loss. So this is an interesting trade, but you got to move and you got to move within your time frame. And that brings me to my last set of trades, and that is called a synthetic. I love synthetics. Does this remind you of anything else that you saw? It should remind you of buying the stock. Unlimited upside, unlimited downside. Now you look at this and you see I only have to move from 230 to 237.40 to break even. That's $2. All right, that's pretty darn good. All right, so break even's at 237.40. I only got to move $2. The cost of this trade is cheap. The problem is I could lose my entire investment. So here's how I think I'm going to trade AGX. This is educational purposes only. This is I used to call it a chicken shit synthetic. It's basically a synthetic call. I buy one call at 230. I sell a 230 put. That gives me the same upside as being long. And then buy a protective put, not at 230, but let me edit this spread. At 220, I buy a protective put, and that gives me my downside. So I'm going to pay $17 here versus 26 for the call. But I'm going to risk not only the $17, but the $10 between the short put and the long put. So I'm basically a long call and I'm short a put spread. I like this trade because it has the least amount to move to the right to be profitable. Since the stock is at 235 and my short put's at 230, I don't have a big move to go. As you could see here, break even is 247.35, so only $12, $11.40 to make this a profitable trade. Break even on the downside, I got to get to that same number or I start to lose money. I've capped my risk much more than the call, but I'm getting in at half the price of the call. So this is the trade that I'm probably going to take, but I am also going to consider buying long a call and looking at a married put. Have an awesome, awesome day in the market. Remember, this is education. Stocks are easy. Options are hard. Make sure you got an options education. Don't do trades without talking to your financial advisor. And remember, I'm not a financial advisor. I give chemotherapy. Have a great day.